In this video, I'm going to address a question sent in by Jared, and he asked, what is the 3-day and the 3-week chart? So before we get into it, take a quick look when you have a minute here and read this disclosure, and then we'll get right into it. I've been trading for over 35 years, and in my experience, I glean that markets, for whatever reason, play out in threes. You've got triple tops, triple bottoms, head and shoulders, inverse head and shoulders, triangles, cup and handles, which are basically 3-point patterns, etc., etc. 3-point trend lines, which often define major breakouts above and below 3-point trend lines. So I created the concept of the 3-day chart and the 3-week chart to define primary and secondary trends and to define turning points. And basically, the concept is very simple, but it can get a little bit tricky. Um, all trends and cycles are composed of a primary and a secondary trend, or a primary and secondary cycle. So the 3-day chart does a terrific job of defining the line of least resistance, or the secondary trend, whereas the weekly trend, the 3-week chart, does a super job of defining the major trend. But I'll show you where it gets a little tricky as we go on. We're going to use the S&P as an example. So you can see that this is the from January 2019, and well, let's pull it back a little to take a look, and you can see you had a major low, the Christmas low, and obviously it's a major slide, and the 3-day chart is pointing down. Okay, so back, let's get to basics. The 3-day chart turns down whenever you have 3 consecutive lower lows. That's intraday lows, not not closing lows. Conversely, the 3-day chart turns up when you have 3 consecutive higher daily intraday highs, again, not closing highs. So you can see here that after this slide, the 3-day chart is conspicuously down, and right off the low, you get 3 consecutive higher daily highs, and the 3-day chart turns back up. And we'll get into this pattern back here in a little bit. First, I want to stick with the basics. So the 3-day chart points up, turns up here, and continues pointing up all the way until March 8th. Here you get 3 consecutive lower daily lows, and you can see that it defines a low. Succinctly, when you're in a strong uptrend, a turn down in the 3-day chart typically defines a low soon in terms of both time and price, especially the first time the market does something. And here you have the first time that the S&P turns its 3-day chart down in a strong upthrust. Again, it remains up until the May 1st high, and the 3-day chart turns back down. Here you have 3 consecutive lower daily lows, and immediately the 3-day chart turns back up. Here, let's zoom in a little bit. You can see you have 3 consecutive higher daily highs, 1, 2, 3. However, you see a little bit of a change of character. This turn up of the 3-day chart defines a high. So you have a change in complexion, and you trade back below what I call the circled. The last 3-day chart low is a circled 3-day chart low. That's the only other way the 3-day chart can turn down. The inverse is the same. The rules are reversed. 3-day chart, the circled 3-day chart is up, and you turn down. And if we had taken this circled 3-day chart high out immediately from here, let's assume you had a large 1 to 2 day spike theoretically, without turning the 3-day chart back up with three consecutive higher intraday highs. um, that would have turned the 3-day chart back up. But in this case, we're talking about lows, and when the index trades below this circled 3-day chart low, right where this arrow is here, uh, the 3-day turns back down and it extends. Looks bearish. You have an undercut of the 200-day moving average as well, the 200-day, and this is basically a test of the March 8th low. So the market has a memory, and it tests this low on an undercut of the 200-day, just like this undercut of the 200-day here. So you have a possible double bottom, and when the 200-day is recaptured with authority right here in early June, the next trading day from the low, mirroring the action back in early or mid-March, it leads to a turn up of the 3-day chart. Three consecutive higher daily highs, and you continue higher. And look what happens last week, last Wednesday. Again, you have three consecutive lower daily highs, and it immediately defines a low. And lo and behold, we have a gap to new record highs this morning on the heels of Trump's excellent Asia adventure. So that's the story of the 3-day chart. Let's take a look at the weekly chart. Well, before we do that, there's something important to show. Let's go all the way back to look at the September high first of all. So here's your September high, and here's the October test failure. And immediately off the high, the 3-day chart turns down. That's a warning sign. When the 3-day chart turns down sharply, you have a gap, and it's not just an orderly pullback. It turns down pretty sharply, undercutting its 50-day moving average, this blue line, immediately off a high. So that's a bit of a concern and a warning sign. Moreover, when the daily swing chart turns up on trade above the prior day's high, it immediately defines a high. So this knifes back down right here. So the 3-day chart turning down decisively right off an all-time high was a warning. And when it petered out, when it fizzled on a turn up of the daily chart and gaps down, you can expect a sharp reaction, and that's exactly what played out. This is the significance of the 3-day chart, and we'll show you the 3-week chart, because they are based not primarily on price regions or price levels, they are based on time. In other words, it is based on not a particular price level, but the 3-day period or the 3-week period. The 3-day chart could turn down or up at any particular price, but it's the behavior when the 3-day chart turns up and down, just as it's the behavior when a trend line is broken. It's not the be all and end all, as we showed you when the 200-day was broken back in March, and then in June. It's the behavior once a trend line or an important moving average is broken. And the significance of the 3 day and the 3 week chart is that they key off of time more than they do off price. So taking a look back a little further at the major um, late January 2018 top. Let's get back there. Here we go. You can see that we had a similar pattern to that of October 2018. Here's your blowout move um, into January 26, I believe. And the 3 day chart again turns down decisively, immediately off of a high. And this gap was a warning because it leaves an island top as well. So the 3 day chart turns down off an island top. The expectation and the presumption is lower prices. This green arrow marks where the 3 day chart turned down, and the gap the next day tells you that you're most likely in a fast move down. So, same picture here. Now we want to go to the weekly chart. It is really rather, I might want to add, it's really why it's 3 days. I can't tell you, but it's really rather mystical and breathtaking how exact the 3 day chart and the 3 week chart can be. So let's go to the weeklies and look at the 3 week chart right now. So you can see that since the December low, sorry, the 2016 low, the first time you get 3 consecutive lower weekly lows, and again, we're not talking about closes, but the first time that you get 3 consecutive lower weekly lows from this point here in 2016, I think this was Brexit. Um, since the late 2016 low, since the election, the very first time that you get 3 consecutive lower weekly lows is in August, right here, 2017. Okay? And that is almost a year, and that perpetuates the blowout move into January. Remarkably, even that um, knife down, that plunge down from the um, high here in January 2018, does not satisfy 3 consecutive lower weekly lows. In fact, the 3 week chart doesn't actually turn down until December 2018. The first time the 3 week chart turns down in all of 2018, since this turned down here actually in August of 17, is where this little box is here. Here's the first time you get 3 consecutive lower weekly lows. And the action is bearish, but it's near a low. In other words, you get a further whoosh. But once this point is recaptured, where the 3 week chart turned down, remember the market has this memory, it knows where the bodies are buried. The first time that it does that, turns the 3 week chart down, is an important DNA in the market. And this is a harbinger of things to come. When the market recaptures that level where the 3 week chart turns down, it's talking. And in fact, it turns the S&P turns the 3 week chart back up um, right here as soon as it could. The first 3 weeks, right off the low, it turns it up, and you have a little pause week, an indecision week, but then it extends higher. And the 3 week chart has remained pointing up since the Christmas low of 2018 here. You can see that even in the sharp, virtually almost 20% pullback into early June, you did not get three consecutive lower weekly lows. Almost, but almost is not a cigar. This is a rules based um, concept. And this week here, you have two consecutive lower weekly lows. This week here does not see trade below the prior week's low. So you do not see three consecutive lower weekly lows. So this is, despite this um, plunge, uh, the T-Rex in the ointment is that the underlying big picture trend, um, obviously you don't want to stay in here all throughout this, but it is telling you that once you see the 3 week chart turn down, the likelihood is at least you're going to see a um, a strong rebound off the, remember, the first time the market does something, and this is the first time it turns the 3 week chart down within a year, the likelihood is you're going to see at least a sharp rebound, if not a move all the way back up to test the highs. And you test them here with a nominal overthrow, then you have a sharp pullback, and now we're making new highs again. And we'll see if, again, as was the case back here in September, where you had a nominal move above the January high and a plunge. Likewise here, we'll see if this new move here satisfies a megaphone or broadening top, successive higher highs, successive lower lows. Um, it's like a megaphone. That's why successive higher highs, successive lower lows. We'll see um, if we get a buying climax on this spike on a kiss toward the 3,000 level where this trend line comes in. So that's something to watch for. But let's take a look at, off of the 3 day and 3 week chart, I developed and created the +1 -2 buy setup, and the inverse of that, the -1 +2 sell setup. But let's take a look at the um, the the buy setup first. So here's the daily chart again on the S&P, and remember that the 3 day chart turns back up with three consecutive higher daily highs right off the lows. And here you have, that satisfies the +1 of my method. 3 day chart turns up, satisfies the +1 part of the +1 -2 buy pattern. The first two consecutive lower daily lows, intraday lows now, not closing, satisfies the -2 part of the equation or method. So +1 -2. I often get asked, well, does the -2 have to come right on the heels of the 3 day chart turning up, the +1? The answer is no. It's the first two consecutive lower daily lows. When the 3 day chart is pointing up, that puts you in the +1 -2 buy position. Now, sometimes that's a good risk to reward entry. I will typically wait to the next day, obviously, to see that you're going to get a turn and maybe buy on an opening range breakout, but certainly trade and close over this bar, over the -2 bar, um, is a um, is a signal of a turn to the top side. And the opposite is true. and we're going to show you a chart of a couple of stocks that we've taken positions in, and one will show you that we were not in, but is a great example of the -1 +2 sell, and that's Nvidia. So let's take a look at Nvidia. And here's the pattern I'm looking at. So Nvidia tops back here. Actually, I think it even topped earlier than that. But the 3-week chart, sorry, the 3-day chart is down. You can see 3 consecutive lower daily lows. And right here, you get 2 consecutive higher daily highs. So the 3-day chart is down for the -1 part of my -1 +2 sell method. This is not the buy method. -1, and then it goes into the +2 sell position with 2 consecutive higher daily highs. Moreover, not only does it go into the sell position, but it does so with a large range outside down day. And that is a marker for a continued slide. You continue lower the next day, and the daily chart turns up and fizzles and turns right back down again, and you get this gap, and you get a strong move in the short-term traders. Obviously, that is what we're looking for: fast moves in short periods of time. And this method of mine, the +1 -2 buy setup, and the -1 +2 sell setup, are superior tools to define the line of least resistance. So let's um, let's take a look at a couple of positions that our subscribers were in last week. One that we were not, one that actually we didn't take Xilinx. The other three, AXSM, DXCM, and CRTX, that we were in, and we are actually remain long AXSM. So first, let's take a look at AXSM, since we still hold a position there. Here's Axum Therapeutics. We're looking at the daily chart. So this is actually one of the biggest winners of all of 2019. And you can see here it's from the $2-3 level. It's run up all the way to $25. So it's a 10 bagger, and carves out a well-defined cup and handle, turns the 3-day chart here, leaves a 180. By that I mean it's in an uptrend, closes near its lows this day, and then closes near its highs the subsequent day at its 20-day moving average for a holy grail. So multiple setups, it leaves multiple setups, and multiple setups enhance the odds of a successful outcome. And what are those multiple setups? You've got pattern, the cup and handle. You've got the 3-day chart pointing down, turning down at the 20-day moving average for a holy grail. It's what I call a holy grail buy setup. When a stock pulls back in a strong trend, when a stock pulls back to its rising 20-day, and the stock leaves a 180. We anticipated a turn up out of this because the market was in a strong position as well. And fortunately, our stop did not get hit, and it exploded the next day. If they're not going down, they're likely going up. So a lot of times you'll find that these very orderly setups, these very well defined setups, will see a shakeout bar and shakeout weak hands, and that creates more blue sky and ease of movement on the way back up because there's less overhead. And it looks like after this large range day on Thursday and Friday's little narrow range contraction day, that we're going to get an expansion today. We should up to higher highs, and we'll probably lock in some more profits on this one. Another one that we took long last week that we closed out on Friday is CRTX. And here is a classic example of a plus one. The 3 day chart is up and strongly so. So it's a plus one, 3 day chart is up, minus two daily buy setup. Here, the 2 day chart, you can see two consecutive lower daily lows. While the 3 day chart is up, you get some kind of a stutter step in here. You don't get immediate gratification, but it turns up here. We are long from the 34 region, sold half up here, and we sold the balance on the expansion and range on this new high close on Friday. We took the gains because we were there was uncertainty going into the weekend, and we had big gains of 5 points on the back half of the position. Uh, Ditto, we did the same thing with Dexcom, and we'll show you why. It offers an interesting example. So Dexcom pivoted off a nice base. It's been in a strong uptrend prior to that, but it's a whippy stock, and you can see here it turned its 3 day chart down, three consecutive lower daily lows, and closed on its lows, so we didn't do anything here. But it basically tested its rising 20 day, this red line, this red moving average, on a Wednesday, and we saw the setup. So although it went 1 day more than it continued lower for 1 day past the turn down in the 3 day chart, um, the market is not a fine Swiss watch. You have to give it some latitude, but rather than um, we use some discretion rather than buy it into the hole here. We use an opening range breakout, a breakout over the first half hour range to get long on Thursday, and we were triggered long. I believe it was about 144.40, and we took our gain here before the bell on Friday, because what do we have? We have a minus one plus two. So it's in a potential test, and it could roll over, maybe back test the lows, maybe puts in a double bottom, maybe it's just a reflex bounce and it's going to roll over. Um, but we locked in the gains, and you can see that it may be carving out a misshapen cup and handle, kind of a flat cup rather than a rounding base. Be that as it may, we'll watch and see what it does over the next couple of days. Um, and then let's take a look at GLD. This offers a great example. We put subscribers long GLD calls prior to the breakout. And let's take a look at the weekly. Show how uncannily that defined a low. We've been stalking this potential cup and handle below these multiple tops here, and the assumption was that if the handle worked, it would elicit a push above these multiple highs and a breakout. And that's certainly what we got. And what's interesting, we pull back the lens, you can see here, we got a turn down in the 3 week chart by 1 penny. The the 3 week chart is up here. It's up here, doesn't turn down, and the 3 week chart turns down here by 1 penny and then turns back up here and continues higher. It explodes. So it's as long as this breakout pivot here around the 128 level, 129 holds, I think this is a buying opportunity. Last one, which is not a setup that we took, is Xilinx, probably the best, most loved chip stock. At least it's my go-to chip name. Let's take a look at the, well, we're on the weekly, so let's take a look at the weeklies first. Obviously, off the December lows, it was up almost 100%, and the 100% rule came into effect in a big way. You had this huge outside down week, and the 3 week chart finally turns down here, 3 consecutive lower weekly lows, and does this in the region of the last breakout pivot. I'm sure this is going to look like a little cup and handle on the dailies. So this pulls back in the vicinity of that prior breakout with the 3 day chart down, and then what we would do is go to the dailies and let's see what there is to see. So here's your low day, and you get a bottoming tail, but the 3 day chart turns up here, and the trend is basically down, so that defines a high, and the Xilinx tails off. But something funny happens on the way to a test of this low. The 3 day chart turns back down. Rapid flipping, here's a little secret I want to tell you about the 3 day chart. Rapid flipping of the 3 day chart oftentimes defines a change in trend. So here the 3 day chart is back up. Here the 3 day chart turns back down, and it does it on a back test of the 20-day moving average and tails back up. You get an indecision bar here, an inside bar, but it booms the next day and turns the 3 day chart back up here right below the 50-day moving average. You get a little consolidation pattern. Looks like it's going to roll over here, but there's no downside follow through, and follow through is always key, and turns back up here. And today, this morning, pre-market, looks like Xilinx is up 5 points on the heel of you know the talks getting restarted with China, which is giving a tailwind to the chip stocks. So I think that about wraps up the this discussion on the 3 day and the 3 week chart. I hope you found it illuminating, and if you want to learn more about my service, please be sure to click on the link. Thank you.